Good afternoon, everyone. Welcome. It has been quite some time since we did this last, but I am thrilled to be back with everyone. My name again, for those of you who don't know me, is Andrew Sindler, although you probably guessed that from coming onto my YouTube channel to see this video. Um, but welcome all that come to view this video. You probably noticed I'm a little more, I'm not fully dressed up, but I'm certainly a little bit more business professional looking than usual. And that is largely because I literally just came off of a presentation that I did for the National Organization of Social Security Claimants Representatives, NOSCAR. This is actually the second presentation I've done for them in the last 7 months. I did one at their national in-person conference back in May in Nashville. And now I just did one. It was a virtual conference, but had quite a number of attendees online, doing the same kind of thing I'm doing right now with a Zoom meeting and a PowerPoint slideshow. And I was really pleased to get and privileged to get asked to do that once again. I'm looking forward to doing many more as I do for all of you. And I gave a lot of good plugs to our YouTube channel here and everything that we've been able to accomplish in a little over a year's time since I started this channel, and hope to keep things going for a long time to come. So again, sorry, life's been a little busy, work and personal life, certainly holidays as well. Actually, that just reminds me, so I'm not all work and no play all together, just to get a little bit in the holiday spirit. There we go. Hopefully that's not too distracting for everybody. As I see, half of my hat is in the blurred background, but we'll do our best. But I hope you all are enjoying the holiday season. Fall is a great time of year for the most part, with all the really great, heartfelt and fun holidays, starting really with everything in the fall from Halloween onward. Hope you all had a great Thanksgiving. Hope you're gearing up for a great winter holiday season. Whatever holidays you're celebrating, Christmas, Hanukkah, Kwanzaa, any of those, Boxing Day. And then certainly a very hopefully prosperous New Year, as this will certainly be the last video I post before the New Year. So I'm looking forward to great things to come in 2025 and beyond. So, without further ado, we're going to get into the topic of today's session and video. This is not the topic that I presented on. In fact, for those of you who have been to this channel and viewed other videos, the topics that I presented on to mostly my fellow colleague attorneys and staff across the country are topics that I presented to all of you on already. So you actually could have kind of schooled them in that. No, just kidding. But no, it was topics on the work history report and function report forms, two of my most popular videos that many of my existing and potential clients view regularly. So definitely always glad to share that knowledge with anyone I can. But today is a new topic. It does have a little bit of overlap into some topics I've talked about before, but this is also something that comes up pretty regularly in practice, and it is relevant and definitely, I think, something that's helpful to know. So without further ado, I will do my traditional screen share and we'll get right into it. All right, start the slideshow. Okay, so our topic for today is different types of Social Security benefits. So up to this point, we've pretty much been 100% focused on just different types of disability benefits and all the topics pertain to disability. But I would be remiss if I didn't mention and now give a little bit more insight into the other types of benefits that Social Security offers and how there can be some overlap and interplay between them. So that is going to be the focus of today's video. It's probably not going to be as long as some of my other videos, but I, again, want to be as thorough as I can. So let's get right into it. As always, my About Me page, nothing has really changed on there. Everything's pretty much the same as it's always been. So always glad to help anytime I'm able to. That's the whole purpose of this YouTube channel. Okay. So let me actually move this screen over. It'll be out of the way better that way. Okay. So what are the different types of Social Security benefits? Let me summarize it first, then we'll get into some more specifics. All right. So I'm actually doing this in order of I'm going to bring them all up at once. In order of the acronym OASDI. You probably have seen that acronym a time or two, perhaps. and maybe even wondered what it all stood for. Well, I'm here to talk just about that. So the OA of OASDI stands for old age, which is just a less kind and politically correct way of saying retirement benefits, which was established under the Social Security Act when Social Security itself was first created under a former president by the name of Franklin Delano Roosevelt, one of the greatest in history, in 1935. Then the S of that acronym is survivors benefits, which is kind of an offshoot of all different types of benefits, but we're going to talk a little bit about that. And then lastly, we have the DI stands for disability insurance, which are SSDI benefits, but of course that also incorporates SSI. The disability program was established in 1956, and then the SSI program in 1972. And that's what leads us largely to what we have in today's agency and today's programs. All right, well, let's delve into them a little bit. And some of this might be a little bit repetitive, just because, particularly on the disability stuff, because I know I've referenced it to some degree in some prior videos. But let's talk about it a little bit more. Oh, every time I think I'm out of the way, I got to move myself over. All right, SSDI versus SSI. Now, again, I know I've talked about this a little bit. I think my original video that I did when I started the YouTube channel in August of 2023, that's the ABCs of SSD, does spend a little time talking about this, but I'm going to go into probably a little bit more detail than I did in that video. All right, so these are the two main programs of disability benefits. Now, I'm not going to talk about it in this video, but as you probably know, I've done another video on different types of childhood benefits, both childhood SSI and then disabled adult child benefits, which comes under SSDI. So those are all included for the purposes of this, but it all comes under disability, essentially. So Social Security Disability Insurance, or SSDI, which is governed under Title II of the Social Security Act, and Supplemental Security Income, SSI, which is governed under Title 16 of the Social Security Act. And there are some similarities, but also some really important key differences between the two. And I'm going to go over those now, like I said, in a bit more detail. This is something that comes up very regularly in my practice with new potential clients, with existing clients. People don't always know whether they're eligible for one or the other or both. And this is the whole point of doing this, is to try to explain it a little bit so you can become more familiarized with what types of benefits might be appropriate for you and you might ultimately qualify for. All right, well, let's start with just the similarities between the two. This is what they have in common. First of all, the medical disability requirements are exactly the same, aka the 5-step sequential evaluation process. So everything that I went over in my original video, again, the ABCs of SSD, applies equally whether you have applied for SSDI or SSI. No difference in the medical requirements whatsoever. They can't say you're disabled for SSI and not disabled for SSDI, medically speaking. Both programs also pay monthly amounts, just the same, and they all may pay a lump sum past due benefit amount once the case is awarded. So they have that in common as well. Now, you might have been expecting more similarities, but for the most part, that's pretty much where it ends. This is where they diverge. So let's talk now about the differences between the two. And to do that, we're going to start with talking about just one at a time. So SSDI is a disability insurance program. That is why it's right there in the name, Social Security Disability Insurance. This is a program that you pay into when you work and you pay taxes into the specifically Federal Insurance Contributions Act, or FICA. So I'm sure all of you that have been out in the working world, and you certainly see taxes drained from your hard-earned money on your pay stubs or direct deposits, and you've probably heard about paying into FICA, as we call it for short. Well, when you are paying those taxes, you are basically contributing to your own insurance policy that you may or may not ever have to cash in on. And that's what SSDI, that's how it functions. It functions no different than an insurance policy. Now, there are certain requirements to qualify. The first one is that you have to pay in for a minimal period of time to reach what we call, quote, fully insured status, which is equivalent to 40 quarters of coverage, QCs for short, or we sometimes refer to them as work credits. Now, to attain a quarter of coverage, I didn't put this on the slide, and you can look this up online. You have to work and earn a minimal amount of money in a given calendar quarter or year. And it is a really minimal amount that will trigger a quarter of coverage. And it's all pre-tax dollars, and it doesn't matter whether you're doing full-time or part-time work. It all comes down to the amount you're earning. And if you earn some of it in one quarter and not as much in another quarter, they'll still look at the whole calendar year, which consists of 4 quarters, 3 months at a time. And based on how much you have earned and paid into the system over that total year, if you divide it into the 4 quarters and it exceeds, on average, the QC triggering amount, then you will get a quarter of coverage. The most amount of quarters you can get in a calendar year is 4, since again, there's 4 quarters. So it takes 10 years to attain the 40 quarters of coverage to get fully insured status. Now, I'm skipping around a little bit. That will not apply the same, at least for disability purposes, if you become disabled at a young age. Not the young age of disabled adult child benefits that I talked about in my prior video, but if you become disabled prior to age 31, then you don't have to reach that many. Now, similar to the fully insured status requirement, you also have to meet a recency test where you generally need to have worked and earned the minimal amount for quarters of coverage for 20 out of the previous 40 quarters before you became unable to work, or a little bit easier said, 5 of the last 10 years. Again, unless you're disabled prior to age 31. Now, this section I referenced here, this 404.130, that's under the Code of Federal Regulations within the Social Security Act. And that one, it's on the Social Security website as well, so you can find it there just as quickly. But that code section will tell you what the requirements are. You can just do a quick Google search and it'll come right up, but that tells you how much you have to have worked and paid into the system prior to age 31 to qualify. Now, if you are found disabled under SSDI, you are getting back proportionally what you paid into it. So that's where it operates, like I said, no different than an insurance policy. And it's not even specifically that you're getting back dollar for dollar what you paid in, but proportionately, because you are paying in and a certain calculation is being done, not only based on how much you're paying in, but based on how much everyone who's working in the country is paying in and your fair proportion of that if you were to become disabled. So at the end, you're still basically getting back what you paid in, like almost any other type of insurance policy that works out there. When you pay money towards a medical insurance policy, for example, health insurance, and you have to go get medical treatment that your policy covers, you are getting back basically, in theory, what you paid into the system. Like you're prepaying for medical care that you may eventually need. And that's how pretty much all insurance works. I won't go into an insurance pitch like that. I'm not an insurance salesman. Now, also like an insurance policy, when you stop working and stop paying into the system, because the payments, again, you want to think of them as like premiums, you will eventually lose coverage on your cutoff date. And we formally refer to that as the date last insured, or DLI. Your DLI will always be at the end of a calendar quarter that corresponds with when you stopped working. So each calendar quarter ends in March, June, September, or December. That's the 4 quarters of a calendar year. So when you stop working, if you've worked consistently, your date last insured or cutoff date will usually be a few years after you stop working. The average person is at least 2 to 3 years after they stop working. Some might even qualify beyond that, depending on how much they've earned and paid into the system over however many prior years before they stop working. Now, this is important to keep in mind because to qualify for these benefits, you need to prove that you became disabled on or before your DLI, your date last insured. Now, for most people, that's not necessarily an issue because by the time they apply for disability, their cutoff date hasn't occurred yet. It's usually some date down the line into the future. But there are many occasions, including many of my current and former clients, where they have a remote date last insured. So they come to me, they've either already applied or they're looking to apply, but they stopped working several years ago, which means their DLI is already in the past as well. which means you can allege that you became disabled on or before that date, but you have to prove it in order to collect those benefits. So even if you're disabled currently and you can prove that you're disabled currently, it may not matter if you have to prove, let's say you became disabled as of December 31st, 2022, 2 years ago, give or take. And many people find themselves in those types of situations. And it doesn't mean you can't pursue such a claim. It just means it might be a bit more of an uphill battle. And talking with an experienced attorney like myself that knows the ins and outs of that can definitely help determine that. Continuing along with the differences. Now let's focus our attention on SSI. So SSI, on the other hand, is a government welfare program, and it pays eligible disability recipients directly, regardless of their work history, regardless of them paying into the system. If you don't meet the fully insured and or the recency tests that I referenced a couple slides ago, you could be eligible for these benefits as an alternative. Now, because the government pays these benefits, they are considered what we call needs-based benefits, which means they will not pay them unless you can show a financial need in addition to medical disability. So the government's paying it out of their pocket, not based on anything you paid into the system. And because of that, they have a vested interest in making sure they only go to people that have a financial need. And it's unfortunate to say that, and I'm going to get into this in a little more detail in the coming slides. If you are medically disabled, but you can't qualify for SSDI and you can otherwise support yourself or have someone that can support you sufficiently, they may say you're not qualified for these benefits. Now, specifically, you need to meet what's known as the resources requirement to qualify. Resources, there's a formal definition. I didn't include the code section on this, but resources are basically countable income and assets beyond certain allowances they give you. So there's certain things they certainly won't count against you because that wouldn't be fair. If you own a home, they're not going to count that against you, even though there's hopefully equity in your home that would easily put you over this resources threshold amount. But they won't count that. They currently won't count one household vehicle, and I think there is currently legislation in progress that might raise that to 2 vehicles per household, which would be great. Even though vehicles don't typically have equity in them either. Vehicles tend to depreciate for the most part. Certain vehicles may not, but cars certainly depreciate over time. So they don't count that. And then there's certain allowances for basic necessities like food and clothing and shelter and things like that. Once you get past all that, Social Security starts counting every dollar of value in any assets or any source of income they can. And the current resource limit is $2,000 per month for a single individual and $3,000 a month for a married couple, all pre-tax dollars. And if you're married, your spouse's countable income and assets are going to be imputed to you as well. So also, you can qualify for each of these types of benefits initially, but then come a point in time where you don't qualify in the future if you exceed the resources in any given month. And there could be disruptions. Like there could be one month where somehow, for whatever reason, maybe you get an inheritance or maybe somebody gifts you something that suddenly has value that puts you over the threshold amount. You can still collect SSI, you just may not see it in a given month, for example. But that's how the resources limitations work on SSI. And it's important to bear that in mind because if you think you might only be eligible for SSI, you want to try to get a pretty decent handle on that before you even apply, because you don't want to go through all the rigorous work of applying and going through the claims process for them to determine, yeah, you are medically disabled, but guess what? You can't meet these requirements, so we can't pay you. It's a painstaking ordeal. I've been through it a number of times with clients. It's tough, but you definitely want to do what you can to try to avoid that when possible. All right, continuing with differences here. Another key difference between the two is the start dates of those types of benefits. So for SSDI, with both types of benefits, when you apply, one of the first things they ask you on the very first page of an application is, when do you believe you first became unable to work? Or specifically, what do you contend to be your alleged onset date? And more often than not, Social Security, if they find you disabled, will find you disabled as of whatever date you gave them. So with Social Security Disability Insurance SSDI benefits, if you are found disabled, they will first take the onset date that they've determined, whether it's the same one you gave or some different one. and then they will add 5 months to it. So basically the sixth month after that. Or they will look at 1 year prior to when you applied, or what we refer to as the protective filing date. And the protective filing date, if you're not familiar, is the date that you initiated your application. You may not have completed it on that date, but once you start it, you're given a period of time to complete it, and they'll still use the date you started it as the date you actually applied to protect your interest. That's why it's called the protective filing date. So both dates in each hand. 5 months after the onset date, 1 year prior to the protective filing date. Whichever of those two dates is later, that's when your benefits will start. And for the purpose of determining your lump sum past due amount, that can add up to a decent amount. Because most people, once they get approved, are approved well down the line from when they actually became disabled. So Social Security has to catch them up. And that's where that's relevant. Now, SSI, on the other hand, is a little different. The furthest back an SSI claim can be paid is the date that you filed for benefits, your protective filing date. It could be later than that if Social Security determines a later onset date than the date you applied, even if you alleged an earlier one. But again, it can never go back prior to the filing date. So that's important to keep in mind as well. Particularly if you're trying to say you became disabled years ago, but you're just now applying this year. You don't typically need to do that on an SSI claim. Most people can and should just choose the date they're applying to make a cleaner record. I actually had a case recently that was approved, SSI only. Client applied in February, but they're saying she became disabled in October. So they will only pay as of October unless we appeal it. All right, monthly benefit rates, another big difference between these two. And it's a pretty significant one, I might add. So SSDI is paid based on what's referred to as your primary insurance amount, or PIA. So this is, again, basically proportional to what you paid into the system over time. And it does have a maximum monthly cap that does go up year to year for cost of living. So going into 2025, I tried to make this as recent as possible since we're already in December of 2024. The maximum monthly benefit amount, no matter how much you've paid into the system for disability, is $4,018. It will go up again next year and every year thereafter, most likely. But that's the highest monthly amount you can collect. And if you have past due benefits available to you, it'll go by the calendar year of whatever your amount was or whatever the maximum was if you exceed that. And the most important thing to keep in mind, which you're going to understand when I get to the next bullet point here, with SSDI, there is zero consideration of income and assets, which basically means, as I tell my clients all the time, you can have $1 million in the bank. You can own homes all over the world. You can own this, that, and the other thing, and you'd still collect your full SSDI because you paid it into the system as an insurance policy. That's how it operates. SSI, on the other hand, is established yearly by the government. The maximum monthly benefit amount going into 2025 is going to be $967 a month, and it could be lower if you have any countable resources that they can use, not necessarily to say you don't qualify if you don't cross those $2,000 or $3,000 threshold amounts I said on the prior slide, but if you have anything countable, they can deduct it from that and you get less. Now, again, both of these increase yearly with cost of living adjustments, or COLAs, as we refer to them. Now, this is important too. This is a big distinction, and I try to advise clients on this as much as possible, particularly if they come to me having not yet applied, so we can try to avoid this trap and pitfall. Generally, you can't collect both types of benefits. The only limited circumstance where you can collect both is if your monthly SSDI amount is less than the maximum monthly SSI amount. So if you worked and earned enough quarters of coverage, but your earnings were so minimal that your monthly SSDI amount, let's just say, I'll give you an example, a numerical example. Let's say it's only $500 a month. That's $467 less than this maximum monthly SSI amount, which means that you could potentially also collect another $467 in SSI. But where it gets tricky is they have to look at your income and assets for that $467 portion. And again, even if you don't, with countable resources, exceed that threshold amount, you could still have countable amounts enough that it cuts into that additional $467, and you're still not getting the full maximum SSI monthly amount, but you might get more than the 500 you were awarded. For the most part, if you've worked and paid into the system long enough, you are typically not going to have an SSDI monthly amount that is less than whatever the maximum SSI monthly amount is. It's usually going to be some four-figure amount, 1,000 or more or more per month. I think the average, I want to say when I last checked it, is like 1,500 a month for the average person. That's well above the SSI amount. If you exceed that SSI amount by even $1, you can't collect both. You can only collect SSDI. And in some ways that's good, because that also means that you won't have to deal with any of the income and asset thresholds to address. And that means they'll never look at it in the future either, because that's another thing too. With SSI, if you get awarded and they determine you're eligible, they're constantly checking to make sure you don't exceed those limits. And that's going to continue for the rest of your time that you're on SSI. So for some people, it's a welcome break not to be collecting SSI for that reason. Now, as I'm sitting here talking to all of you, I created this slideshow late last night, very late. So my brain wasn't functioning probably at full capacity. I'm realizing there's one important distinction between the two that I didn't put into the slides, and I'm going to talk about it right now before I go into the next slide, because I think it's important to know too. I'm not going to get into a lot of detail about it. When you are eligible for SSDI and SSI or SSI, you're also eligible for medical insurance if you don't already have it. So for each one, there's a different insurance you're eligible for. With SSDI, you're immediately eligible, or not immediately, I'll get into that in a second. You're eligible eventually for Medicare. And with SSI, you're eligible for Medicaid. Now, with SSDI, there is, just like there's a 5-month waiting period from your onset date, there's a waiting period from your onset date before you can collect and start receiving Medicare benefits. So it's actually a significantly higher amount, and I'm not sure why this is, and I think there is pending legislation to try to eliminate it or at least reduce it. But the current waiting period for that is actually 29 months. I don't know why it's such an odd number, but it's basically almost 2.5 years from the date you became disabled. Now, for some people, again, that's not necessarily an issue because they became disabled years prior before they file. And by the time they get approved, that 29-month period will have already passed. But for some people, not. And if they don't have coverage, that could be problematic, although usually you can get some form of state Medicaid assistance while you're waiting for Medicare. And again, if you get SSI, you have Medicaid assistance pretty much immediately. The other thing to keep in mind is that with SSDI, Medicare coverage is, Part A, which is the hospital coverage, is required, and there's no premium for that. That's fully covered. But Part B, which is the regular medical coverage and doctor visits, that part has a fairly meager premium amount. It's usually like around $150 or so a month that they take right out of your benefits. But that is something that you generally have to take, or you could face steep penalties and consequences if you try to take it at a later date. Even if you already have your own coverage through a spouse, through a former employer, through a state or municipality, it doesn't matter. You're still required to take it when you get SSDI. And something I won't go into now, or that I don't go into in the slides, but I'll just quickly mention in passing now. When we start talking about retirement benefits, age 65 is the triggering age where people must take Medicare currently as well, even if they already have coverage, and Medicare becomes their primary insurance. So again, don't want to turn this into an insurance discussion. That's not really relevant to what we're discussing, but just wanted to mention that for good measure. All right, next slide. Other facts and considerations. This is probably where that should have gone, but again, I didn't think to put it in, so hopefully you'll have it now. Both programs, again, may pay a lump sum of past due accrued benefits, but this does vary case to case. And the way I described how they determine it on the prior slide should explain that. SSDI past due benefits, when they are available, are paid all at once. And if the amount is up to a certain level or higher, usually about $30,000, then it usually triggers 2 levels of review and 2 sign-offs before they release it, which is separate from your monthly benefit amount. So you'll start getting monthly pretty much when they tell you, and it'll be the same date of each month, like the third Wednesday or whatever it is. But the lump sum can hit unexpectedly at any time. Sometimes you get it before they tell you it's coming, because they'll always send you a notice of award letter telling you when it's coming. SSI, on the other hand, is paid out differently for the past due period. By law, they're required to pay it out in 3 installments over a 1-year period, and they're not equal installments. The first 2 installments, and I'm not sure why to this day, I've never really looked up why the amount is never quite the same. It's usually somewhere between $2,000 to $2,500 in those first 2 installments, which are 6 months apart. Sometimes it could be like in the 2,600 range. I don't think I've ever seen it higher than that. And then the final installment is the balance of what's owed after that. And by the way, for both of these, this is also after attorney's fees are deducted, because that's where attorney's fees comes out of, which I'm going to get to in a second. Now, I didn't write this here in the slide, but I'll also let you know, for those of you that are applying or will apply for SSI only, if you have a dire need, financially or medically or both, and you can prove it with documentation, you can sometimes get these installments expedited or get the full amount dispersed all at once. No matter how that all happens, once you have it, if you're suddenly sitting in your bank account with an amount that's higher than the threshold, which for many people they will before they get to spend any of it or use it, Social Security gives you a 9-month spend down, where you have 9 months from the date it went in to spend it down below the threshold level before they will suspend your benefits for any given month that you're above the threshold level. I have a case right now where a client was incorrectly determined to have higher than the threshold amount when they didn't, and we have bank statements to prove it. So that appeal is still pending, where they suspended her benefits for a period of time for reasons I can't explain. Just somebody wasn't paying attention, seemingly, and that does happen. So you want to make sure you're on top of it as well. Not to mention, with SSI, you always want to make sure that you are regularly keeping Social Security in the know. You want to make sure that you're telling them what you have and when you have it, so that they're not caught off guard. Again, attorney's fees are paid out of these lump sums. I know I talked about this a little bit in my original video, and any of you that are current clients, you know this as well. These cases are taken on a contingency basis, so we get a percentage of the past due amount, which may be capped at a certain maximum amount. The current maximum amount that just went into effect at the end of November is $9,200. That is slated to now start going up with cost of living, just the same. We didn't used to have that as attorneys, but and we didn't used to get regular increases either. We averaged one every 13 years. So it's a nice welcome change for us, as amounts are going up over time as well. Also, under SSDI, if you have children under the age of 18 during your disability eligibility period, whether it's your current period of eligibility going forward or a past due one where you had a kid that was under 18 but is now over 18, you can also receive additional benefits for them, which are known as auxiliary benefits. This is not childhood SSI. This is not saying your child has to be disabled. This is just saying to help you support your children under your primary insurance amount and your family maximum benefit, which is a higher amount. You're eligible to receive up to a certain additional sum, up to whatever your maximum level is. And again, this is intended to help you support them. Even if you have kids that are not living with you, if you are divorced or separated from your spouse or significant other, and you have children in common, and the children live with the ex-spouse or ex-significant other, you can still receive these benefits, but they must be used for the children's benefit up until 18 and graduation from high school. All right, let's talk a little bit. This sort of nicely bridges the gap into survivor benefits, and specifically survivor eligibility for SSDI and SSI. So sadly, this happens more often than it should because of how backlogged the country is in general. But if a claimant dies before their claim is decided, no matter what level it's at, under certain circumstances, a qualifying family member can substitute on their behalf and continue pursuing their claim. They may be eligible for both any past due amounts that have accrued and any ongoing lump sum amount. but they can at least continue at that point in time. Now, for SSDI, the three family members that can typically substitute in are a spouse who was living with the claimant at the time of their passing, an ex-spouse, if they meet certain requirements, including the duration of their marriage and other such requirements, and a child or children who are dependent and or disabled, as well as any parents of the deceased individual who were dependent. When you file your application for benefits for SSDI online, they ask you all these types of questions about whether you're currently married, whether you have any ex-spouses where the marriage lasted at least 10 years. That's the threshold for that. They ask you about children under the age of 18 or disabled over 18, and they ask you about if you have any parents who are dependent on you for one half of their support. And the whole purpose of that is to start determining ahead of time who could be a suitable substitute claimant if you do pass before your claim is decided. For SSI, the only eligible substitute is a surviving spouse who was living with the deceased claimant at the time of their death or within 6 months of their death. If you don't meet those rigid requirements, an SSI claim cannot be continued. Spouses and ex-spouses also may be eligible based on their age and or disability status, and whether they have their own primary insurance amount / earnings record that is higher than the deceased. Because when a spouse is eligible to collect benefits under their deceased or ex-spouse, Social Security, for one thing, is going to look at what's going to yield you the higher amount. Because if you can earn more under your own earnings record than under a spouse's, you're going to take your own and not bother with your spouse's. They're not going to allow you to double dip. They never do. All right, perfect segue into old age and retire or / retirement benefits. And again, this is not something that typically comes up, partly because if you're eligible for retirement benefits, which I'm going to get into in a minute, you generally don't need an attorney. There's not really much to go through in terms of a qualification, as you'll see momentarily. That doesn't mean these issues don't come up from time to time. Doesn't mean I can't help advise people and guide them through it. But you're also going to see a little bit of overlap and interplay in just a minute as well. All right, so when we're talking about retirement benefits under the Social Security Act, we're talking about two primary types. And retirement benefits, by the way, also pretty much come under Title II of the Social Security Act, just the same as SSDI. So we're talking about early retirement benefits, or ERB for short, or full retirement benefits, FRB. Unlike SSDI and SSI, and even certain survivors benefits under those programs, the only requirements for retirement benefits are, number one, having fully insured status, and there's no such concept as a date last insured with retirement benefits. Once you get those 40 quarters, you've got the coverage you need, but also your age is the one and only determining factor. You got to reach the right age to put in for these benefits, and then you're eligible. Early retirement benefits, I'm sure many of you probably are aware, begin as early as age 62. And generally, age 67 is the start of full retirement benefits. I say generally because there might still be some people in some prior generations alive that are in some kind of hybrid group where they might reach retirement at like 66 and a half or 66 and 2/3 or whatever. But most people currently that are heading towards retirement years, based on their year of birth, 67 is going to be their full retirement age. And then age 70 is the maximum full retirement age. So when you reach age 70, you're going to max out. No matter how, even if you go beyond age 70 and don't collect until 75, you'll get what you would have gotten at age 70 based on cost of living adjustments as well. Now, important consideration, and you're going to see where this is also important on a later slide. Early retirement benefits pay at a considerably lower rate than full retirement benefits. So if you're planning to take those, you need to be prepared for a hit that you may be taking and that may become a permanent one, which again, you're going to understand with the interplay. Now, as with SSDI, benefits and PIA rates are determined based on historical earnings, with maximum amounts each year, just like with SSDI, and they also again increase with cost of living. And the longer you wait, the higher the benefit rate you will receive. Spouse / ex-spouse benefits may also be available once you start drawing your own retirement. There's age and marriage duration requirements as well. And these are typically things any Social Security field office would advise once you start taking. If you have a qualifying spouse or ex-spouse, you can determine then what they're eligible for. And those benefits are paid separately from yours. It's not like it cuts into yours and suddenly you're getting $500 a month less because your spouse is starting to draw his or hers. Retirement versus disability. Now, I've been teasing this for a while. Here comes the big interplay and overlap. So generally, there is no overlap or interplay between the two, specifically because if you're receiving SSDI before you reach full retirement age, which generally by definition is what that is, once you do reach full retirement age, your benefits will automatically convert to full retirement benefits. And then your SSDI benefits really were essentially early full retirement benefits. So it's like you're taking full retirement at an earlier age without a penalty. And they're proportionally adjusting it based on the age you are when you receive SSDI, but you are not getting any kind of like early withdrawal penalty. And when you do reach your full retirement age, it'll get to the level that it would have been had you just retired at that age. So if you are on SSDI, you're receiving benefits payable as disability benefits where you have to keep proving disability medically, and they're paid out of the disability trust fund of Social Security. When you hit full retirement age, you no longer have to, and I'm going to talk about this in a future bullet point, but you no longer have to prove medical disability, and you're paid at that point out of the retirement trust fund, which is a very different one. Now, like I said, there are some times where the two types of benefits overlapped and can impact each other. And here's generally what you need to know about that. If you are receiving retirement benefits, but your benefit rate is very low because your earnings historically were not high and you didn't pay a lot into the system, you could be eligible for additional SSI, again, up to the maximum monthly SSI amount, just the same as the overlap between SSI and SSDI. Same exact concept. So an elderly person that needs assistance can potentially qualify if they meet the resources requirements for that additional SSI. Now, if you are age 62 or older, but still not at full retirement age, you could put in for disability benefits, SSDI and or SSI, and then elect to draw your early retirement also. Now, I've been running into this more in the last couple years alone than I ever used to my whole career. I've had a lot of clients that have come to me that are either just about at age 62 or over age 62. And when I apply for benefits for them online, when I do their SSDI application online, oh, by the way, I forgot to mention, just to quickly refer back, another just sort of housekeeping and technical difference between SSDI and SSI, even though I know they're working to change this. SSDI can be applied online directly, and an attorney can do it for you. You don't have to be physically present. SSI, on the other hand, still cannot. SSI either has to be done in person or by phone with your field office, and you as the claimant have to be the one to do it, even if you have an attorney. I think that's partly to protect everyone's interests because, again, since these are government-paid benefits, the government has a vested interest in making sure someone's not fraudulently pretending to be you online and file for SSI benefits under your name and social security number, even though it's not your earnings record. But coming back to what I was saying before, when you apply for SSDI online, once you put in your date of birth and the system recognizes that you're 62 or over, the system will eventually ask you if you want to start drawing early retirement benefits while your disability claim is pending. Now, I'm going to talk about that in a little more detail in just a minute, but you don't have to do that. It's not a requirement. It's just an option to you. And if you have no other source of support, for some people, that's a nice little lifeline that they have that not everyone has the benefit of. Now, if you do start drawing early retirement and then eventually you get qualified for SSDI and they realize you've been disabled over the same or some of the period of time you were receiving early retirement, they will basically look backwards and pay you the difference between what you should have received for SSDI versus what you did receive for early retirement, because SSDI by rule always pays at a higher rate than early retirement. And then from that point forward, your monthly SSDI amount will overtake the early retirement benefit and will become a disability benefit until, again, you reach full retirement age. Now, big caveat here. If you do elect to take early retirement and you don't eventually get approved for SSDI, then you are permanently stuck with that lower monthly early retirement amount versus the full retirement amount you would have gotten at age 67 or older. And you can't undo it once you put in for it. You can't have a buyer's remorse on this. So you have to think long and hard. And typically, for that reason alone, I advise my clients, if they can financially weather the storm, I typically tell them, don't put in for early retirement if you're putting in for disability. Not to mention, it creates a more convoluted calculation at the end of all when all is said and done, of determining um, uh, what your past due amount is going to be when they have to do all those offsets. It can get really, really complicated and take extra time to calculate. If you haven't been receiving any early retirement, then that's a non-issue. All right. Now, as I referenced earlier, once you convert to full retirement benefits, if you've been on SSDI, you're no longer required to prove medical disability. And along those same lines, you're no longer limited as much by the amount you can earn should you try to return to work. So specifically for full retirement benefits, which again, this goes up for cost of living just like everything else, you can actually collect your full retirement benefit rate and still earn up to $62,160 a year or $5,180 a month for 2025, which is, for people that are receiving retirement, that's not chump change. And that's really nice to have that available. Whereas with SSDI, or SSI as well, you can earn no more than the substantial gainful activity amount, which is currently $1,620 a month pre-tax, which is quite a pittance in comparison to the full retirement rate. So that's why it's especially advantageous when your Social Security disability benefits convert to retirement benefits at age 67. So some final thoughts here. With all the different types of benefits available, it's important to have an understanding and, where appropriate, request assistance in obtaining the right kind of benefits to ensure the maximum amount available. So this is something, it comes up more frequently than not, of somebody coming to me, particularly, it's generally for disability related purposes, because again, if it's just retirement, you typically don't need an attorney. You just have to prove your age to get it. And at the end of the day, just because you say I'm medically disabled and I can't work anymore doesn't mean it's cut and dry determining what types of benefits you might be eligible for. And if you're not currently eligible, will you be eligible at some point in the future when you meet certain other criteria? So I've had cases, for example, where I have a client that didn't have enough quarters of coverage for SSDI, had a spouse that was supporting them and couldn't qualify for SSI, but eventually was going to get to a point where they could be eligible under their spouse's earnings record once they hit a certain age or a certain duration of marriage. And I was able to say to them, look, we can't do anything now, but if your condition stays the same or gets worse, come back to me at this point in time in the future, and we can assess whether you could be eligible then. Or if you suddenly are no longer married and separated or divorced, and you don't have your spouse's income and assets imputed to you, come to me then and might be able to do something at that point. Timing is also a very important factor, particularly when we're talking about the interplay between SSDI and early retirement benefits. I tell clients routinely, if they haven't already done this, once they come to me, if they want to file for Social Security disability and they also want to start drawing early retirement to have something coming in to help support them since they can't work, I always tell them it is very ideal and important to file for disability first and then elect the early retirement benefits. Because if you do it in the opposite order, if you take early retirement and then suddenly put in for disability, somehow, some way, I hate to say something like this, but it's not beyond the realm of possibility for somebody to look at it and wonder if you simply had some buyer's remorse. If somebody got in your head and said, oh, well, you put in for early retirement based on your age, and that was fine, that's automatic. But then somebody told you, or you found out, that you could actually collect a higher rate for Social Security disability and then eventually collect your full retirement rate if you're disabled once you reach full retirement age, and you want us to pay you a higher amount, but are you really disabled? Or are you just doing it to try to get the higher amount? Now, I, of course, know, and you all know, that's not the way most people operate. Certainly no one I've ever come across, and I would never allow that kind of abhorrent behavior. I mean, that's pretty atrocious as far as I'm concerned. Um, but at the end of the day, again, the people on the other side that make these decisions might look at it a little bit askew, and we don't want to give them any reason to do that. So that's where I say again, it's better to have put in for disability to get the essentially the consistent theme that I'm putting in that I can't work because I'm disabled. And yes, I recognize I've got a benefit available to me, but I'm still disabled. That doesn't change that. But yes, of course, I want to take advantage of having some money come in while my disability is pending. It really does make a big difference. And it's why I always tell my clients, go in that direction. That's really important. And as always, as I always tell everyone at the end of these, if you have any questions, I'm always happy to answer them anytime you do have them. Phone, email are the best ways to contact me. I respond directly to calls, emails, and texts. And always glad to help lend a hand when I can. So, with nothing further, I wish every one of you again the happiest and healthiest of holiday seasons and New Year's. I'm looking forward to seeing and continuing with you in the new year with some additional topics I'm already starting to brainstorm. And I will see you all soon.